Good evening.
Hello.
Hey, how are you?
Hello. Good evening, sir. Good
Good
morning
evening.
for you, I guess, sir.
Yeah, it's 9 o'clock in the morning here, so it's not that early in the morning.
So good evening. Good evening, everybody over here. Before we start the session, I would like to request Professor Sharad Nath Bhattacharya to come up and say a few words on behalf of the institute.
Okay. Can I ask you a question on the Q&A? How is this going to work? Because I see the auditorium, and obviously the people in the auditorium are the ones going to be asking questions. How exactly are the questions? Is there a mic that they'll walk up to? What's the process by which that's going to?
Is this mic working? Right. So, ladies and gentlemen, good evening to the people on this part of the world, and good morning to the person on the other side of the world. My name is Sharad, and I am the mentor of this finance club of this institute. And it's my privilege today to stand before you to welcome a distinguished guest, a guest whose contribution to the world of finance is nothing short of transformative. Please join me in welcoming Dr. Aswath Damodaran, very fondly called the Dean of Valuation. Please.
Thank you.
Sir, allow me to speak 1 minute about our institute.
Sure.
We are the 7th IIM of the country. Government set up IIM Shillong in 2007, and we have just entered the 18th year of our existence. Within this short span of 18 years, we now have our MBA batch size of 400 participants. And out of these 400, there is a bulk group who are very much interested in the finance domain. And when I say finance, the majority falls under the umbrella of investment banking. Everybody is interested in valuation. And therefore, without any further invitation or reminders, we have our hall filled today. All thanks to your contribution in this field. I welcome you, sir, to this platform. And without further ado, I invite the organizing team, the student team, to take this forward. Thank you.
Good evening, everyone. It is an absolute honor to welcome you all to this exclusive session organized by Team Niveshak at IIM Shillong. Today, we have the privilege of hosting one of the most renowned voices in finance, a mentor to countless investors, analysts, and students worldwide, Professor Aswath Damodaran. Often referred to as the Dean of Valuation, Professor Damodaran is the professor of finance at NYU Stern School of Business, where he has been shaping the minds of future financial leaders for decades. His groundbreaking work in valuation, corporate finance, and investment strategies has made him a guiding force in the industry. Through his books, lectures, and research, he has simplified complexities of valuation, bridging the gap between theory and real-world application. Today's session, Narrative and Numbers, will take us beyond the traditional financial analysis, exploring how numbers alone don't tell the full story. Is the narrative behind them that truly brings value to life? This is the rare opportunity to learn directly from the best, gaining invaluable insights that can transform the way we approach finance and investing. We extend our heartfelt gratitude to Professor Damodaran for joining us today and for all of you for being a part of this insightful discussion. Without further ado, let's dive into the session. Welcome, Professor, and thank you for being being here with us today.
Thank you. I'm going to try sharing my screen before we get started. So let's see if I can get that working. Screen showing up, right? Can you see it? I can't hear. Can you see my screen or now?
Yeah, it is visible.
Before I start, though, I mean, thank you very much for all the amazing words, and there are a couple of stories I have to tell you before I start that kind of bring me back down to earth. I've heard myself referred to as the Dean of Valuation 3 times already, and every time I get on CNBC, that's what they call me. But do you want to know the real story of how that came about? About a decade ago, I was on CNBC, and the anchor had trouble pronouncing my name. And to be quite honest, even Indians don't get my name the same way every single time. I've given up on what the right pronunciation is. I accept every possible variation of Damodaran, which is not really my name. And and there's a story behind it. If you know people from the south or you're from the south, in Chennai, you don't have a last name. You have only a first name. And your father's first name is the initial on your first name. So I grew up as D. Aswath Narayan. And usually you have a caste name as your last name. Can I stop the echo? If you could mute the other side, I won't get an echo, I think. I'm sorry, the one of these has to be muted. Okay. I'm going to mute that, so I think that'll stop the echo. So I use my father's first name as my first initial. But the caste names got lost somewhere along the way. So in 1979, I left India to go to the US to go to college. And I was in the flight coming into LA. I was going to UCLA. And on the flight, as we get to the last 2 hours, they give you those forms to fill. In those times, it was physical forms. And of course, it asks for a first name and a last name. And I never in my life ever used my last name or had a last name. So I fill out my first name and I say, what the heck do I do now? So I took my father's first name and I made it my last name. I could have created any last name I wanted, to be quite honest. So Damodaran has been part of my name now and it's really my father's name that's become my last name. Long story. People have all kinds of trouble pronouncing that last name. In fact, at NYU's MBA class, every year they run what's called a Follies, which is, the MBA students put on it's a comedy show. And one year, an entire segment of the show is they went down to Washington Square Park, which is right outside NYU. And they asked people to pronounce my name to see all the various mispronunciations that could come out from the name. So people have trouble with my last name. This anchor was having trouble. He tried and he tried and he was screwing it up. And finally he got tired. He said, look, I can't pronounce your last name. I'm going to make up a name. I'm going to call you Dean. Dean of Valuation. I said, okay, if that's easier. And somehow it stuck. People think I got called Dean of Valuation because of my profound wisdom in valuation. I got called Dean of Valuation because people couldn't pronounce my last name. So let's get that out of the way. I was also described as somebody who has shaped people's minds. Oh man, that's a terrifying responsibility. I hope I haven't. Now, I nudge people. That's all I can do. I can point them in a direction. I can give them a sense of how to think. But everything they do is theirs. And finally, I heard you were all passionately interested in investment banking. What's wrong with you people? Why would you want to go into a profession where you're essentially hired by a big name investment bank and they basically use none of your brain power for the rest of your job? You're churning out big spreadsheets, you're an Excel ninja. I know exactly why you're going to investment banking. And let's be honest with each other. You're not interested in investment banking, most of you. You're interested in the paycheck that comes with investment banking. And I don't mean that as a bad thing because my kids started there and I talked them out of it. I said, don't go work in investment banking. It's the most soul sucking place to be because you will get to use none of the stuff that makes you who you are. Hopefully by the end of the session, some of you will rethink going into investment banking, because I want to talk about something that many investment bankers claim to do. They claim to do valuation. I came to NYU in 1986. This is almost my 40th year teaching valuation. When I came to NYU, there were no classes on valuation anywhere in the world. There was no CFA program. There were no books on valuation. It was considered to be too shallow a subject, something that you really did not spend time doing research on. I invented this class at NYU, and this semester, I'm teaching the 59th and 60th semester that I've been teaching this class. One to the undergraduates, bunch of 21-year-olds, 350 people in the class, and one to MBAs, a couple of hundred people in that class. It's exactly the same class. And I've wrestled with the question of what goes into evaluation. So I'm going to go give you a very compressed perspective on how to think about valuation that maybe is subversive because it might cut against everything you've learned about valuation. And let me explain. I'll give away my age. When I first valued a company, it was 1981. You know what I had to start my valuation with? I had to write to the company, actually take a fountain pen, not even a ballpoint pen, a fountain pen, write to the investment relations officer of the company and say, can you please send me an annual report? I'm trying to value a company. Send it out by mail. To give the company credit, 2 weeks later, I get an annual report. And I sat down to value the company. Here's what I had in front of me. I had a ledger sheet. Most of you are too young to even know what a ledger sheet is. It's just a blank sheet of paper with lines drawn through it. So basically, it had the columns already drawn. Incredible innovation on my part because I could never get the lines straight. I had a calculator, not a slide rule. I'm not that old. And a pencil. I learned very early in my valuation life, don't write things in pen. Everything's going to be a mess. And I sat down to value a company. Think about it. If you're valuing a company with a ledger sheet, a pencil, and a calculator, every cell has to be hand calculated, right? How much detail can you have? As little as you can get away with, because every line item you add, you have to estimate each cell by hand. There's a reason I'm telling you the story. In 1981, when you valued a company, you really thought seriously about adding more detail because it was so much more work. Valuations were parsimonious because you had no choice. Today, when you sit down to value a company, think of what you do. You open up an Excel spreadsheet and you're off to the races. Adding a line item is trivial. Add an extra worksheet, getting more data. Everything has become easier, right? And you'd think that valuations would have become better 40 plus years later because you have more data, more powerful tools. But from my perspective, the quality of valuation today is actually worse than it was 40 years ago. And worst of all are the valuations I see coming from banks claiming to be discounted cash flow valuations. So I think about this a lot because this is what I teach, and I wonder what's gone wrong with valuation as a profession. Where did we leave the tracks? And I think two things have happened. One is I think valuation has become financial modeling. It's not valuation anymore. It's financial modeling. It's an Excel spreadsheet where data feeds in. And the second is I think we're no longer in connection with the businesses we're trying to value. We don't think about businesses. We think about line items. So in my classes, I sell this idea of parsimony. In the physical sciences, there's this principle of parsimony. What the principle of parsimony says is when you go out and try to value something, you start with, or when you go out and try to explain something, start with the simplest explanation for it before you make yourself Einstein. In valuation, I have a very simple principle. When you try to value something, ask yourself what the least number of inputs you can get away with valuing it is, not the most. I have never in my lifetime ever valued a company with more than 12 line items, ever. If you gave me a company to value and you took away my computer and you gave me a ledger sheet and a pencil, I can still value a company with a ledger sheet and a pencil because I've only 12 line items. Because ultimately, most of these layers of detail that you see added in are completely pointless. They're distractions. So I'm going to start by showing you my picture for what drives the valuation of a company. Did I lose my picture? Let's make sure it's coming. Did I screw up now? Did my slides disappear? Can you still see my
No, sir,
screen?
we can hear you.
Oh, but can you see the slide that says value drivers?
Yes,
Can you
sir.
see? Yeah, okay, good. So here's my big picture of what drives the value of a business. No, you give me any business. It could be ITC, it could be Asian Paints, it could be Ola, or it could be NVIDIA. Here are the three things that drive your cash flows. And these three variables you can use to explain almost any business model and convert to cash flows. The first is revenue growth. What does that capture? The growth potential for your company. So as I go through this process, I want you to think about your favorite company and say, how would I estimate it? What drives the growth of Ola? What drives the growth of ITC? What drives the growth of Asian Paints? Revenue growth. You know why I focus on revenue growth and not earnings growth? If you have a mature company with no growth, can it still report earnings growth? Yes, by cutting costs, by playing accounting games. You can't play games with revenues. To get more revenues, you either have to raise prices or sell more. So I'm going to focus on revenue growth. Second driver, growing by itself doesn't make you a valuable company. You got to make money. So the second driver is, how much money can this company make? What are the margins of this company? And the margin I focus on is the operating margin. A little bit of insight. If you took your accounting class and you kind of skated through it and you really cannot read a financial statement, you're going to have a tough time in valuation because I say some terrible things about accountants, but the truth is your raw data comes from accounting statements. Operating income measures income before interest expenses from the operating assets of the company. You have operating margins. Now, again, if I left you to your own device and say, would you like a low margin or a high margin? Everybody wants high margins. But the problem is you got to live in the business you're in. Some businesses like software, you can have high margins. We'll talk about what drives that. Others, you'll have low margins. The third driver of value is what did you reinvest or what are you planning to reinvest to get that revenue growth? Growth is never free. You can't just change your growth rate from 12% to 18%. You can do it on a spreadsheet, but in a real business, to increase growth, you got to build more factories, invest more. You're going to capture that with the reinvestment. The growth, the profitability, and the reinvestment are what drive cash flows. And there are two metrics for risk. One is the discount rate, and I won't go dance through all the specifics about how you get a beta and a risk premium and risk-free rate. If you're interested, I do entire sessions on those. But the bottom line is your discount rate will be higher for riskier businesses and lower for safer businesses. That's the first dimension on risk. The second is something we tend to forget. When you do a discounted cash flow valuation of a business, you're assuming your company will be a going concern. What does that mean? In your world, if your company has a bad year, it'll always bounce back and come back. Nirvana is always there. The big terminal value number will keep you going. But in the real world, companies do fail. You know that 2/3 of startups don't make it to year two. If you're doing a discounted cash flow valuation of a startup, you got to bring that in explicitly as a failure risk. That's my big picture valuation. And I'm going to very quickly dance through some of these inputs because it's going to lay the foundations for the storytelling part. So let's think of a company that you want value. Let's say it's your own company. You founded a company, you're an entrepreneur, and I come to value a company and ask you, how quickly will your revenue grow? What does your heart tell you to say? High growth rate, right? We all want high growth rate. So let's think about what goes into why we give some companies low growth and other companies high growth rate. The first is, what kind of market are you going to go after? You're a tobacco company. Your growth rate is going to be low. You know why? Because your total market is stagnant. There are fewer people, even in India, smoking, and that population is aging, so the total market is going to be small, is going to basically not have much growth. If your total market is small or it's not growing, your growth rate for your company should also reflect it. Conversely, if you're a company in a growing business, smartphones 15 years ago, not today, but 15 years ago, the market was big and growing, so both Apple and Samsung, you could give 15, 20% growth. Times have changed though. Today, when you value Apple or Samsung, that growth rate is going to be much lower. So, how big is the market? How quickly is it growing? The second question you could ask is about your company itself. You're going after a big market. There is no guarantee that your revenues are going to grow with that market, right? Because you're competing. So you got to tell me what your current market share is and what you do that makes you different from your competition, because you got to fight them off. Do you have lower costs? Maybe that'll let you grow faster. Maybe you have a better product. So those things will go into what kind of market share I can give you over time. Total market times market share gives me revenues, and that can change over time. So already you can see for some companies, you can have much higher growth than others. And turn to operating margins. Operating margins are what you get to keep after your operating expenses. What drives whether a margin is going to be high or low? The first is unit economics. You know what unit economics measures? It measures how much money you make on the next unit you sell. Let's play it through. Okay? Let's assume you get on the Microsoft website and you subscribe to Office 365. I don't know how much it costs in India, but let's say it costs, in the US, it costs $89 a year to have the subscription. So I put my credit card in, I pay $89. Microsoft receives $89 of my money, right? Here's my question. How much is it going to cost Microsoft to make that extra copy of Office 365 for me? You know what the answer is? It costs them absolutely nothing. The unit economics for a software company are insanely good. That's why when you look at the operating margin, for even an average software company, you would see 30%, 35%. If you're a really good software company, you'd see 55%. But now let's pick a different company. Let's pick Tata Motors. Tata Motors sells a car. Let's say you buy a Tata automobile. They get the revenues, right? But that car that they sell you has to be made in a factory. Even if you're the most efficient auto company in the world, your margins are not going to be 80, 90. You're lucky to get double-digit margins. You tell me what business you're in, it already constrains you into what kind of margin you can have. It's true there are economies of scale. It's kind of a buzzword, but what do economies of scale tell you? That your costs or some of your expenses grow at a lower rate than revenue. So if you're scaling up and you tell me your margin is improving, you're drawing on economies of scale. So I'm going to ask you, what are the economies of scale in this business? Some businesses, you can have massive economies of scale, some you don't. And the third is, you don't live in a world where you set prices and everybody else just sits there and watch you do what you do. You live in a world with competition. So we're in an incredibly competitive business. Much as you'd like great unit economics and economies of scale, your margins might not go up because the pricing of your products will go down because of the competition. So that determines what your end margin is going to look like. How you get there will depend on where you're starting. So if your end margin is going to be 15%, you're starting at 12%, not much room to move, so it's easy to get there. But if you're starting at minus 50%, you have to get to 15%. It might take you a lot longer. Second is, how do you run your business? What do you prioritize? If you're like Paytm, and all you think about is how many users can I get rather than how do I make money, guess what? You can scale up, but you might never get to your target margin because you're not focused on it. This doesn't happen by accident. You got to plan for it. And third, some business models are going to be closer to delivering those target margins than others. I'm amazed at how many $100 billion companies are out there with business models that are still in formation. I don't think there's a single ride-sharing company with a working, sustainable business model. Not Uber, not Lyft, not Ola, not Grab, not Didi. It's a terrible business. Those things all feed into margins. And finally, the question of how much do you have to reinvest to get there? It depends on what kind of company you're in. If you're a manufacturing company, you have to build more plant, more capacity. If you're a technology company, you got to invest in more in R&D. If you're Uber, you got to acquire customers. What you define as reinvestment first has to be molded to your company. You can look at the past to see how efficiently they've done it. But here are the things that are more qualitative to think about. The first is, are you the type of business where you have to reinvest less to get the same growth as you grow? Some businesses, there is a scaling effect. The second is, do you have excess capacity as a business? If you're valuing Boeing right now, you can give them 10% growth for the next 10 years and you don't have to build another plant. You know why? Because their plants right now are operating at about 50% capacity or less. They have excess capacity. And finally, if you think about this link between investment and growth, there are some businesses where you invest today and you don't get the growth right away. You might get the growth in 10 years. You've heard of Novo Nordisk, right? One of the most successful pharma companies in the last 3 years in terms of what's happened to market cap. For those of you who don't know the history of Novo Nordisk, it used to be a sleepy little Danish pharma company, a small pharma company, which actually specialized in one type of drug, diabetes drugs. About 5 years ago, it got insanely lucky. And you probably know the rest of the story. Two of their drugs, Wegovy and Ozempic, which were designed to treat diabetes, had a side effect that was incredibly beneficial for Novo Nordisk. You know what the side effect was, right? People were losing weight when they were on the drug. And to tell you something, it is, I think, revealing about what we as human beings prioritized. Novo Nordisk has gone up in market times tenfold because its drugs allow people to lose weight than when its drugs were treating diabetes. We value losing 20 pounds of weight far more than can I keep my sugar under control. But the point I'm making is that research that gave rise to Ozempic and Wegovy was done 12, 15 years ago. There are some businesses where you invest and you have to wait. Infrastructure companies. You invest in a toll road, it takes you a long time to build the toll road. It might take you 10 years of investing. So you got to think through what kind of business you're in before you start modeling it in. So with that lead in, let me at least structure this process because I don't want to spend the entire hour just talking. I want to give you about 30 minutes of Q&A. I might not get to all of my slides, but that's okay. So one of the ways I describe valuation in my class is I describe it as a bridge between stories and numbers. What does that mean? Well, every time you look at a valuation, so I'll make one of my valuations your guinea pig. You see my valuation of Tesla, a company I valued repeatedly over the last 10 years. Okay? My most recent valuation was about a year ago. I valued the company and gave it $500 billion in revenues in year 10. So if you look at my spreadsheet, it says 500 billion revenues in year 10. You point to those revenues and you ask, why are your revenues 500 billion in year 10? Here's the answer that's going to tell you nothing. If I say it's because I used a 30% growth rate for the next 5 years, 26 in year 6, 20, it's telling you absolutely nothing. Here's the story you need to hear for you to be able to accept the 500 billion. What business is Tesla in? Think about it. Well, I used to think it was an automobile company, but it's an energy company. It's got all these other things going on. If it were purely an automobile company, 500 billion would be an insane reach. So how do you know? The two largest automobile companies on the face of the earth today, in terms of revenues, are Volkswagen and Toyota. They have roughly 300 billion in revenues, and they sell 5, 6, 7 million cars a year. I have 500 billion in revenues just for Tesla. So there's an implicit story I'm telling first about electric cars becoming a much bigger chunk of the market 10 years from now than they are today. That's a story. I am in my story assuming that Tesla will dominate the electric car market. Is that a given? Who knows? BYD might be the dominant. Maybe an Indian auto company will come to the forefront, but in my story. But I'm actually telling you even more, right? Because if it's just automobiles, you're getting to 500 billion. It's going to be an insanely difficult thing to do. You'll have to sell 8 million, 7 million electric cars every year. In my story has to include revenues from other things that Tesla might do that add to their revenues. Like what? For those of you who've seen a Tesla or been in a Tesla, Tesla is a neat car, but it's a car that runs on software. It's more like a smartphone than an automobile. Without the software, it's just a hunk of metal sitting in your garage. You see where I'm going in my business model, right? Right now, the software comes bundled with the car. So when you buy a Tesla, you get the software with it. But so Tesla updates the software. So if you have a Tesla, every year you can hit it, get the updated software, and it controls everything in the car. Last year, if you remember, or 2 years ago, Elon Musk started talking about automated driving, and the software had an add-on that allowed for this extra special automated driving experience. But it wasn't thrown in with the regular software. You had to pay for it on the side. It was like $1,500 just for that extra piece. But can you visualize a world where Tesla has a software component to their model, where you get the basic software with your car, but if you want to get the special stuff that makes your Tesla do incredible things, you'll have to pay that extra amount. So in my story, there's a car business, there's a software business, and I do think automated driving, much as I think it's been hyped, will eventually become a way in which the ride-sharing business, a portion of it, evolves. For those of you who've been to San Francisco, Google already does this. In San Francisco, if you are a Waymo customer, and basically Waymo is by invitation only, so it's not a huge customer base, you can call for a Waymo. And you know what the scary thing about a Waymo is? It'll pull up in front of your apartment, you run out and get in the car. You know who's in the front seat? Nobody. Essentially, it's a completely automated driving experience. It's here already. Tesla is probably further along on that road than any other automobile company. And in my story, I think they will get revenues from this automated driving, maybe not by operating their own business, but by giving it to an Ola and charging them per car or taking a piece of the fee. That's what I mean about valuation being a bridge between stories and numbers. Every number in my valuation has to have a story that goes with it. And every story I tell about a company has to have a number that goes with it. Like what? Hey, you hear people talking about great management. What does that even mean? Unless you make it explicit, great managers do this, this, and this, it's just a buzzword. When I valued Birkenstock, the German, I don't even know how to describe them, sandal maker, shoemaker. It's a brand name company. It's got great management. You know what makes the management great? The footwear business, even the high end, is a low growth, mature business. Birkenstock in the last 15 years has had a management team that's been able to grow it at 15 to 20% a year. That's impressive. They've been able to do it by being creative, by being imaginative. You can buy a Prada Birkenstock. Prada, of course, is the legendary French name. A Prada Birkenstock will cost you about $1,200. It's just a Birkenstock shoe with a Prada insignia and design on it. That's impressive. That's a creative. So when I valued Birkenstock, I said they have great management, but then I say, here's where it shows. They're able to grow at 15%, even though the rest of the footwear business is stuck at 5%. Every story you tell about a company has to have a number that goes with it. Every number in your valuation has to have a story, which effectively lays the foundations for thinking about valuation. So before I kind of close off my discussion, last September, I wrote my 12th book went into print. It's a Random House book. There's an Indian edition of this book. One of my pet peeves with John Wiley, my publisher of my investment valuation book and my little book on valuation, is John Wiley, as a publisher, decided to entirely remove their Indian edition. Insanely stupid. And this is one reason why I've described the publishing business as deserving of disruption. This is a business that deserves to go out of business. You know what the rationale for getting rid of the Indian edition was? It was cannibalizing the US sales. I remember asking, how many books in the US are you losing sales on because people are buying Indian editions? They said, we don't know. And I said, you're removing the edition of my book in the largest English speaking market in the world from my book because you're losing sales, but you know how many books you're losing? I said, so I was talking to the CFO of Wiley, and he said, I guess that's the truth. And I said, I'm amazed you guys stay in business. This is the stupidest idea I've ever heard. I've not been able to talk them down, but Random House, that was part of my contract. I required them to create an Indian edition. So Random House India has an Indian edition of this book. And this book basically talks about what I call the corporate life cycle. And it's relevant to today's topic, so let me explain what I mean by a corporate life cycle. A corporate life cycle looks very much like a human life cycle. A startup is like a baby, needs constant care and attention and capital. And a huge mortality rate. 2/3 of startups don't make it. If you make it through the startup force, you're a young growth company. So like a teenager, maybe. What do teenagers do? What teenagers around the world have always done? They look in the mirror. They say, I have lots of potential. What can I do today to screw it all up? Teenage companies do some strange things. When I bought Tesla for the first time in 2019 for my own portfolio, I described it as my corporate teenager. I said, this is a company with immense amounts of potential, but every morning one man gets up, he looks in the mirror and he says, what can I do today to mess it all up? You buy Tesla. Don't complain about Elon Musk. You're getting the package. Teenage company. You make it through young growth, you become a high growth company. What's a high growth company? You're at the peak of your life. What does the peak of your life look like? You could go to bed at 3, wake up at 6, and be a fully functioning human being. I can't do that anymore, but maybe you can. Enjoy it for while it lasts, because it's not going to last for very long. My daughter, who just is turning 30 this year, and she's convinced the world is ending. And I said, Kendra, why? She said, I'm going to be middle-aged. She made middle-aged sound so awful that I had to tell her, look, I wish I were middle-aged again. That's way in my rearview mirror. You're now entering middle age, but you're in good shape. One of the great things about being in good shape financially, physically in middle age is you get to do things you couldn't have done as a teenager because you didn't have the resources. But before you complain too much about middle age, remember there are worse things coming down the pike. After middle age comes old age, after old age comes dementia, and after dementia comes death. I am convinced that companies go through life cycles, and your challenges are different at each stage in the life cycle. And when we talk about links between stories and numbers, here's how I think about valuation at different stages in the life cycle. You give me a young startup to value, it's all story. There are no numbers. What numbers are you going to look at? There's no financials, there's no history, it's all story. As you move through the life cycle, the numbers start to play a bigger and bigger role. The way I like to think about this is you're a novelist writing a novel. When you approach a startup, it's like being in chapter 1. But if I gave you Asian paints to value, you're in the middle of the book, right? You can't make up characters now. The characters are already set. You can continue the story, maybe have a few twists. But as you get to the decline phase, even that goes away. You're in chapter 32 of a 34 chapter book. The end is approaching. You can use numbers there, but basically you can see this balance between numbers and story kind of varying across. I don't even want to ask what your backgrounds are, but maybe I'll ask the question. I can't see you very well because it's a big room. But there are 400 people in the MBA program. I don't know how many are in this room. How many of you are recovering engineers? You could put up your hands if you're. How many of you are recovering engineers? Okay. from what I can see, quite a few. I went to an IIM too in 1977. IIM Bangalore. At that time, there were only 3 IIMs, so this was way back in time. There were 103 people in my class. Why only 103? Because we were in this constrained physical campus then. They built a new campus, much bigger. I've never been there. So 103 people. I was one of 2 people in that group was not an engineer. Every other person in my class was an engineer. You know the problem for engineers is? Numbers come more easily to them. They think, they use the word subjective as a curse. You're being subjective. They think I'm going to be insulted. I say, of course I'm being subjective. How can you not be subjective? If by subjective you mean I'm making estimates. You have to. The problem with engineers in my class, and I have quite a few of numbers people, is they can value mature companies fine because they can get away just grinding the numbers. But you give them a startup, the amount of psychological trauma they go through trying to value the company. I make them go through it because it's healthy. It makes them think about their weak side. You can get away being an Excel ninja if all you value is mature companies. But you can't value a young company being an Excel ninja. It requires you to understand businesses and tell business stories. So I'll at least describe the process by which I value a company. And then I'm going to stop and let you ask questions. I go through a 5-step process, no matter what company you give me. The first step to value a company is I've got to understand what the company does, what products and services it produces, who buys it, why they buy it, and what the rest of the competition looks like. Everybody agree? You can't value a company if you don't know what it does. So if you're valuing Cisco and you think it makes vegetable oil, I don't care how great you are at Excel, you're never going to value this company. So let me give you a very quick example of what I mean by this. I bought NVIDIA in 2018. And I'd love to tell you that I did it because I saw AI coming, not even a glimmer of AI in my original story. I bought it because it was undervalued. And then I got lucky in 2022, November 30th of 2022, ChatGPT went public and all of a sudden AI was the storyline. NVIDIA was the prime beneficiary. And in the middle of 2023, I had no choice but to value NVIDIA because it was in my portfolio. I'd bought it at a split adjusted price of $2.80 and it was trading at about $60. Done really well, but I had to decide, should I still keep it on? So I valued NVIDIA. And my first challenge is I have never actually ever bought an NVIDIA product directly from NVIDIA. Have any of you bought an NVIDIA chip from NVIDIA? I didn't even know what, when I wrote my piece, I said, look, I have more experience with potato chips than computer chips. I vaguely know what a chip does, but if you ask me what makes an NVIDIA chip special, I have absolutely no idea. I spent probably my first part of my valuation just talking to people. What kinds of people? People who were engineers who worked at companies that use computer chips. And I wanted to see what makes an NVIDIA chip special. And they kind of explained to me, at least in layman terms, it's much more powerful. And for AI, you need these super powerful computers. They were lying. And the last week told you why they were lying. But they said that's a prerequisite. You cannot build an AI system without NVIDIA chips, and nobody else is close right now. And I remember asking the question, if I start building an AI system with NVIDIA chips, and I want to expand the system, can I use somebody else's chips? And the answer is probably not a great idea, which tells me something about the stickiness of the model. And I did look at the numbers. I looked at NVIDIA's history to see what they've done, and I noticed something about this company that's very interesting. The semiconductor chip business is a mature business, like a 5-6% growth. NVIDIA was an exception because it was a company that went after new markets ahead of the time. If you look at the last decade, they were in the gaming market ahead of everybody else, the crypto market before everybody else, the AI market before everybody else. The first time around, you can say they got lucky. The second time, really lucky. The third time around, you say, look, this might not be luck. This might be something that Jensen Huang has built into the DNA for the company. So the more I saw what NVIDIA was doing, the more my story was framing, which is, this is an opportunistic chip company in the sense of it looks for new markets, and it's in the front line of what's potentially the biggest chip market in the world right now, the AI chip market, which then was about 80 billion, but looked like it was going to trigger, move towards 500 billion. That's my first step, is understanding the company. A lot more work with NVIDIA than if I had to value Ola, right? Why? Because I've used ride-sharing company. I know exactly how this business, it's not rocket science. Much easier to value a B2C company than a B2B company. But that's the first step. Second step, I frame my story. My NVIDIA story, it's an opportunistic chip company. The AI market is going to become big, and I put a number, 500 billion for just chips. And NVIDIA is going to continue to be a dominant player. Saying, how do you know all this stuff? I don't. This is my story, my estimates. That became my story. And when you tell a story, you got to make sure it's not a fairy tale. So I passed it through. Is it possible? Is it plausible? Is it probable? My 3P test. And then I get to step 3. And because my valuations are parsimonious, my life got simple. All I had to do is take my story and say, how does that play out in revenue growth, in terms of operating margins, in terms of reinvestment? And incidentally, along the way, I discovered that NVIDIA was not an AI chip company in the traditional sense. It doesn't make a single chip. It designs chips. You know who makes all of NVIDIA chips? TSMC, which now brings in country risk into the equation, right? Why? Because if China decides tomorrow to cross the sea and go into Taiwan, I'm going to have serious trouble with my NVIDIA valuation. That's going to be part of my story as well, is what do I think will happen to the China-Taiwan relationship? You're saying this is messy. Life is messy. You can't value the Adani Group without making a judgment on who will win the next general election. You don't want to? Don't value the group. Once you connect your story to inputs, the valuation does itself. In my original NVIDIA valuation, I found them overvalued, but not by immense amounts. They were overvalued by about 35%. I sold half my holding. And then to complete my story, I have to remember that the story will never be complete, that things will happen that will change my story. Like what? Every time an NVIDIA earnings report comes out, I go back and revisit my story. Has it changed? It didn't change very much. In fact, it didn't change very much between November 30th, 2022 till last week. So what happened last week? No, DeepSeek came along. What did DeepSeek do? Frankly, the fact that it's Chinese, the fact that they use, those are all distractions. The key thing that DeepSeek did was it changed the storyline on AI chips. Remember those engineers who told me that you needed to invest in really, really powerful chips to do AI? It turns out that there's a subset of AI, at least, where you can get there without the powerful chips and the immense amounts of data. And once you accept that, that changes your NVIDIA story. Not that they won't dominate the AI chip market, but it's going to become smaller. So last week, I revalued NVIDIA with a smaller market for AI chips. Why? Because things change. People often ask me, aren't you uncomfortable changing your valuation? I'd be uncomfortable if my valuations did not change. What my process does is it forces you to take buzzwords and then ask, what does it mean for your company? India is the most highly priced equity market in the world today. Indian equities trade at 31 times earnings now. China and the US are the next at 22. The rest of the world is at like 12 to 15. And what's driving the pricing of Indian stocks up? I'm not using the word valuation deliberately. It's the India story. And we know the India story has legs, right? You know what gives it legs? It's not a supremely efficient government or that your last budget was an amazing budget. What gives it legs is 1.3 billion people. Let's be quite clear. India's biggest strength is you have a huge potential consumer market. So does the India story of legs? Yes. But it's got some weak knees, right? What are the weak knees coming from? One is a legal system that's incredibly slow to deliver even the right judgment. A delayed legal system is just as bad as a non-existent one. So if you're going to complain Russia and China, your legal system is unfair, it's fixed. In India, it never delivers a judgment. You have to wait 32 years to get a judgment. You might as well not have received the judgment. The other weak link is it's got a bureaucracy that is incredibly risk averse. I don't even want to think corruption is always a side. To me, the bigger issue with Indian bureaucracy is it doesn't like to act, because why would they? What's the upside in acting? Because you get flack. So what do? In the old days, you just pass the files on to somebody else, hoping that somebody would make the judgment. Today, you digitally do exactly the same thing. So let's not act like the India story is already there. It's got its weakest links. And I think we will see those weak links exposed at points. But I think the India story, but to justify paying 55 times earnings for Asian Paints because of the India story is, I think, incredibly lazy. So tell me why, because India is growing, there will be more demand for paint. Okay, I'll listen to the story. Then tell me why Asian Paints will remain the dominant player in that market. Tell me why so there's a whole set of links you got to go from the India story. And people are not doing that right now, which means that every Indian company gets this glow of, you're in India, I'll give you a premium. And that's a very dangerous basis for valuation. So my suggestion is step back from the numbers, step back from the spreadsheets, keep things simple, understand what drives businesses, and start asking common sense questions. Don't let people intimidate you with buzzwords. Don't let bankers intimidate you with Excel spreadsheets. Don't be a banker intimidating others with Excel spreadsheets. My idea of a good valuation is somebody in the room who's never been in valuation understands what I'm saying enough that they can challenge me. When I valued Airbnb, the first person I showed the valuation to was not a financial analyst. It's a friend of mine who's a doctor in San Diego who owns 3 Airbnb properties. You know why I showed it to him? Because I wanted to see whether there was some part of my Airbnb story that I was getting. I don't own an Airbnb. I don't know what hosts on Airbnb have to go through in their interactions. And he told me a couple of things I'd missed about the cost structure. I went back and revalued Airbnb. That's why I call this keeping the feedback loop open. I have never in my lifetime in valuing companies, and I've been valuing companies for 40 years, I value probably 30 to 40 companies a year, never once have I talked to the management of a company before I valued the company or during the valuation. Never once. 2 reasons. I learn nothing by talking to top management. Partly because they actually know very little about what's happening in the trenches. You want to really find out whether a retail store is well run, don't ask the managers, is it well run? You're going to get the exact answer you should expect. Of course, it's amazing. Walk into one of the retail stores owned by that company. Look around. Is it well lit? Is it clean? Is the inventory? Do the salespeople actually come to you, or do you have to go looking for a salesperson because they're all too busy chatting with each other? You're going to learn more about your company by spending time in the trenches. I have valued Uber every year since 2013. You know where I've got most of my information when I value Uber? Is when I take an Uber, I talk to the driver nonstop. So I remember when getting an Uber in Dubai, and I said, no, Uber's in Dubai. I said, yeah, I drive for Uber. And I said, who else is here? And he said, this company called Kareem is here. I said, why do you drive for Uber? So basically, I'm trying to extract information because I'm going to learn more about the company's business model by talking to people who are delivering on that service. Spend less time in front of your computer and in front of your data. Spend more time talking to people, understanding businesses. So I want to stop there because I want to give you guys a chance to ask me whatever questions you have. So I don't know the process by which we're going to have the Q&A, but if you're going to walk up to the mic, do so. If you're going to pass on the question to somebody in front, that's fine as well. But let me turn off my slides because that'll just be a distraction. And let the questions come through.
Good evening and good morning, sir. Actually, we have some alums also on the call, and we would just first want some questions of theirs to be addressed.
Hey, you
And
know what? It's stern. Alumni go to the back of the line. At IIM Shillong, they come to the front of the line. Okay, that's fine. Yeah.
so, sir, the first question is from Shantanu, and his question is as follows. We acknowledge the concern regarding the valuation methodologies used by investment bankers. He wants to
Can I
understand.
pause you right there? First thing to do is don't use passive voice when you talk about things. You know why we use the passive voice? Because, so forget the we. So Shantanu, I'm going to take this as a question coming from Shantanu. So basically, I'm going to assume that this is a direct question, but keep going. I'm sorry. So go. We acknowledge. So read again what the question is.
We acknowledge the concerns regarding the valuation methodologies used by investment bankers. I want to
Is Shantanu,
understand if
no,
there,
sorry, is Shantanu an investment banker?
yes.
Okay. So now I kind of get where this is coming from. He's an investment banker. He's feeling a little defensive about what I just said. Keep going. Yeah.
He wants to understand if there is a possibility to find a way to use appropriate valuation methodologies and satisfy the client demands at the same time. Could you please
Let me
share
ask you
some
a
insights
question.
on
How
this?
does an investment banker make money? Anybody from the audience, you're thinking about going to investment banking, right? I want somebody from the auditorium to tell me, let's say you go to work for Goldman Sachs India in their M&A department. That's a great job, right? Everybody is aspiring. I'm sure the audience, that'll be an amazing job. How does an M&A banker make money? Yell it out if we want to, and if I can't hear it, somebody can repeat. How does an investment banker, an M&A banker, make money? Good. No, come on, you should be able to do this. Why don't you walk up to the front of the room and you can talk on the mic?
Hi,
How
sir.
does an
Am I
investment
audible?
banker make money?
So what from we understand is that when they
No, no,
complete
no,
the
no.
deal,
Don't use the passive voice. Just tell me what you feel, right? So
sir,
we understand, we acknowledge, all of that is so tell me what you think investment bankers, somebody got up. So what is
yes,
it?
sir. When they close the deal and the commission that they get
When
on,
a deal gets done, you get paid, right? So
yes,
let's be absolutely clear. What's the end game for bankers? To get
the
deals
deal,
done. Good deals or bad deals?
good deals,
Really?
just deals.
Bad deals, good deals, it's just deals get done, right?
Yes, sir.
Now, do you see why investment bankers, no matter how much they know about the mechanics, are incapable of doing valuation correctly? Because let's say you do a valuation correctly and it tells you not to do the deal. You're faced with this challenge of, should I do the right thing and tell my client not to do the deal, in which case, how much do you get paid? Zero.
Zero.
Or should I do the deal and make $100 million? I think there might be a wee bit of bias in this process, don't you think?
Yes, sir.
What kills banking is bias. It's not that you don't know how to compute cost of capital, how to get cash flows right. Don't blame your clients either. Come on. This is like an electronic salesman trying to sell me a 75-inch OLED TV because he gets a big commission, then accusing me of being the reason he sold the TV. I mean, let's be absolutely clear. Banking in deal making, you first don't value companies, you price them. Why? Because you have to get the deal done. Second, your objective, because get the deal done, is to essentially justify any price being paid. I look at banking valuations. I understand the stresses you work under because you got to keep, your managing director happy and he wants a deal getting done. You don't want your client to get too unhappy, but let's face it, clients are often spending other people's money. You know what I mean by that? If your client is a corporation, you might be talking to the management of the company, but the management is not spending its money, it's spending other people's money. And the ego boost you get when you're the acquiring company in a deal is so great. You say, who cares if I'm overpaying? There's nobody in that M&A room who wants the truth to be told, right? The truth is not setting you free, it's cutting off your lifeline. So the long answer to Santana's question is not that investment bankers don't know what they need to do. Some of them don't, I agree. But even if they did, they're fighting against a business model that is going to induce them to do things that can't be justified, right? You got to get the deal done. Yeah. It's the world you live in. I have the luxury of not having to do it because I value companies for an audience of one, maybe two, my wife and I. That's all I have to keep happy. I don't have to worry about what will. So there is a freedom that comes when you value. So the first thing I would do is recognize the things you can control. So on your personal portfolios, value companies. You have no excuse for saying, I have bias, it's your money. Then you go, let's say you do get an investment banking job, just go do the job. Accept the fact that you're going to be making all kinds of compromises on that job. Because it is essentially requiring you to sell stuff. All banking jobs are selling jobs. The analysis is just part of the sales job. It's not the end game. That's why you can be a great M&A banker and many bankers can't value a $20 bill in a paper bag if you put in front of them. But they're great salespeople. Guess what? They're going to succeed. They're going to get a lot of deals done. So I'm sorry it took me that much time, but so if you want to do good valuations, you got to try to reduce or remove the bias from the process. That's going to be really tough to do at most jobs. Next question.
Hi, sir. Am I audible?
Yeah.
Yeah. First and foremost, thank you so much for hosting the session. I feel really lucky to be sitting through this. Coming on to my question, given that you just spoke about numbers and narratives, how exactly do you account for external narratives that are not directly part of the business?
Let's
So
make
if
it
we're talking
specific. I
about,
talked about the India story, right? The India story
sorry,
is, I talked about the India story, right?
yeah.
Every Indian company you value. Is the India story part of your narrative? How can it not be?
So
Right?
yeah,
So
I was
you say, how
specific.
do you account? I'm not sure what that means because no Indian company can ever be valued without an implicit story about India as a country. So I'll give you an example. I valued Zomato. Right? I'll be quite honest. I've never used Zomato because I don't live in India. It doesn't work here, right? I can't order a Zomato and say deliver it here because it's a long way from it. So the first thing I did as part of the process of adding Zomato is I called I have nieces and siblings who still live in India, and I called them and I said, have you ever used Zomato? How would you like them? And how are they better? They said there's also Swiggy, and I said, what's different? I was trying to gauge it, but then when I sat down to value Zomato, and I'm going to put you on the spot, you stay on there. What business was Zomato in, or is Zomato in? At least, let's go back. At the time of the IPO, what is the only business they were in?
Food delivery.
Not just food delivery, restaurant food delivery. Because remember, the grocery deliveries hadn't started yet. So to deliver food from restaurants, what's the first thing you need? Is you need restaurants. And you need people eating at restaurants. And already you can see the basis of what you need to tell. Because this story about Zomato has to be a story that reflects not just the company and how good it's delivering food, but a story about the restaurant business in India and how it'll grow over time, which requires a story about Indians themselves being willing to eat at restaurants. And I told a story about my grandmother when I was growing up. She lived to be 83. You know how often she ate at a restaurant when she was in India? Not once. Her reaction, if you said, let's go to a restaurant, would have been, and this was in the 60s and 70s, would have been, why would you go to a restaurant and eat food prepared by a stranger in strange ways when you have a cook in the kitchen and you can tell them exactly how to make food and you can control the quality? Indians don't, I mean, as opposed to the Chinese have always had a restaurant culture. Even, middle income and poor Chinese would eat out, but India. So when I grew up in Chennai, you know how many restaurants there were in the entire city? It's a city of millions of people. Probably less than 10, and many of them are at expensive hotels. People just did not eat out. Has that changed? Yeah. Last time I was in Chennai, I think every storefront is what do they call it? A multi-cuisine restaurant. I have no idea what this means, but I guess they will cook every cuisine under the face of the earth, just make it all taste the same. Chinese cuisine, Indian cuisine, Polish cuisine, they all taste the same. Clearly, people are eating out a lot more than they did. That's good for the India story, but for the Zomato story. But there's another component to the story. You know, there are probably 750 million Indians who've never ordered food from a restaurant. Why? Because you live in villages, you're struggling to make it. You don't got to exactly pull up your smartphone and say, let me get biryani delivered to me in my house. So the other part of the story is you need a story of India itself getting more prosperous over time, a growth story. So my Zomato story required me to tell a story not only about India as an economy growing, but Indian culture of eating out also changing, which led to more restaurants, which led to more. So it's almost seamless. It's not like you tell a company story and then think of the macro effects. We're valuing an oil company. Is Middle Eastern politics going to be part of your story? What's the biggest driver of earnings and revenues from oil companies? It's oil prices, right? What drives
Yeah.
oil prices? Demand and supply, and every war in the Middle East is a potential disruptor of that, right? So don't think of it as company story and then I think about the macro effects. They're all swimming in the same pool. And you got to be willing to, I take on what I have to. To value NVIDIA, I have to tell a story about the AI product and service market, whether I like it or not. It's a market that doesn't exist right now. You're getting free AI stuff, but the people are not paying for it. I have to tell enough of a macro story for me to tell the company story. Don't run away from it. It's going to be, you're going to be uncomfortable, especially if you're an engineer. Are you an engineer? What's your background?
No, I'm not an engineer.
What's your background?
But just I did my job in finance for 3 years, and now
So
I'm
you're an
here for
accountant. So basically, you're in the same tribe, right? You think that numbers lead to precision, that if you use stories, it's soft. You got to let that go, right? Because to me, numbers by themselves are just numbers, and you have to start filling in that story.
But my question again, sorry to
Yeah,
elongate
yeah.
this so much, but my question there being, especially when you give an example about the AI market, that is something that is so disruptive and unpredictable, right? We can both have very opposite stories, and none of it
So
can be
why do you
true.
think markets are buyers and sellers?
Yeah, fair enough.
If we all agreed on this story, we'd all agree on a high price, right? So the nature of the future is, why is this just about valuation? You want to eat at a restaurant, you ask 5 people, where should we eat? Are we going to? Of course we are. That's why I said this is my story for NVIDIA, my valuation. It drives my decision. I've never valued a company. You know how much crap I get because of my Zomato and Paytm valuations? So I invested based on your blog post and I've lost money. Hey, it wasn't my money. I didn't ask you to invest. That was my story driving my valuation. You wrote my story to make your decision. Here's my advice. Not just to you, but to anybody who does value. Take ownership of your decisions. What does that mean? Don't take my story and invest in Zomato or Paytm. I'll tell my story, but I'll give you the architecture to make it yours. What does that mean? You could look at my Zomato valuation and say, you know what, I think there'll be a lot more restaurants than Damodaran things, and I'm going to put in, twice as much growth. Hey, it's your story. I'm not going to say I mean, neither of us is in a position to say the other person is wrong because the future is unknown. Don't look for consensus here. This is not a game of consensus. This is a game of feeling comfortable enough with your story that you tell it and accepting that there'll be other people looking at exactly the same company with a very different story. The only thing I would add is if you take a business like beverages, you're going to get less divergence across stories because more of the story is being told. Whereas with AI, the story's all over the place, right? I know people who said there is no AI product and service business. This whole thing is a mythology. We will just never pay. It's going to be free stuff. And there is a plausible pathway where that could end up being true. If you've noticed, there's this AI thing on Zoom now. I have no idea what it does. It's terrifying. There's an AI thing on my mail. I don't feel any urge to use it. There'll be AI everywhere. I'm not paying for any of it. I don't find the way I describe much of the stuff I get from AI is it's neat or it's cute. ChatGPT is neat. Would I pay for it? No, I'm not interested. It's neat that I can ask ChatGPT. And so, in fact, last year when I was teaching my class, somebody asked ChatGPT questions about quiz problems and said, how would Damodaran answer this problem? ChatGPT came up with an answer. They came to me and said, is this answer right? And I said, no, it's okay, but it's very verbose. It seems to have taken everything I've ever done. And I do say a lot of contradictory things. It's neat. So now, do I think it'll change? I think so. At least for the B2B portion, there will be more premium products, but that's my view. The younger a business, the more divergence. One of the few advantages of growing old is I've seen this movie before. Which movie? I mean, remember PC. When I started in 1981, PCs were a young, nascent business. Then 10 years later, the internet. And when it starts, what do? We put all the companies in that space into that, internet companies, right? Which is a ridiculous categorization because Cisco was an internet company making routers and physical stuff. AOL was an internet company because you needed to get online. And Amazon was an internet company that retailed through. So as a business ages, one of the things you start to see is people start classifying companies because you now understand that the internet is not a business. Social media is not a business. AI is not a business. One of the things I hope DeepSeek does, it makes people ask that follow-up question. You're an AI, what do you do? Are you an AI architecture maker? You could be an AI chip company. You could be one of those companies that produces the energy you need. Maybe an AI data company, an AI software company. You could be an AI product company. You could be a service company. We need to start to ask questions that flesh out. AI is a big market. Tell me what your story is within that market. But that story can be very different than somebody else looking at it. And that's healthy. That's perfectly okay. Your job is not to convince other people. It's to convince yourself, right? And I think that's critical is you tell a story that you're comfortable with. That's it. Beyond that, what else can you do?
Yeah, no, thank you so much for this.
Any other questions? Any questions from the audience?
Hello.
You're welcome to come up, everyone.
Am I audible, sir?
Yep.
Yeah. Hello, sir. My name is Yash.
Yash, is what you said? Okay.
Yeah. So my question was,
I can hear you. Keep going.
trying to be hello.
Yeah, I can hear you.
Yes, sir.
Keep going.
Sorry, sir. So my question was kind of more on the side of personal investments. So sometimes you might study a company for your portfolio. You believe it's
That's the
fundamentally
only
sound.
no, let me pause you right there. No, I'll jump in.
Yeah.
I value companies for one reason and it's only for my portfolio. I don't do it because I'm intellectually curious. I don't do
Yes,
it
sir.
for others. I do it for myself. I don't do appraisal for a living. So sometimes you're right. So, keep going.
Yes, sir. So even though you might think the company is fundamentally sound and you believe like it has the capacity to grow, sometimes your call might be wrong. Sometimes it turns out to maybe lose 10-15% in the next week itself. So there was this concept in behavioral finance that we were taught that there's a common mistake of selling winners early and holding losers till late. So I feel this is a mistake that many of us do of holding losers till late. So if you have
Was
experienced
it
this
called
yourself,
irrational when you did that?
yeah, I
Which is,
guess.
I think, my problem with all of behavioral finance. Why do we hold on to losers too long? I'm going to put you on the spot. Forget about, I know there are all these studies. Why do we hold losers too long?
I feel like when you study a stock so much, you kind of uh, I've heard this concept by fund managers called falling in love with the stock.
No, give me
So
your gut, right? No, give me your gut. Why do you hold on to things? Why do we, and this is not just in investing. You make a
yeah,
mistake. Why does it take us so long to acknowledge a mistake? Because when you
uh,
acknowledge the mistake, you're basically saying, I made a mistake, right?
yeah,
Until you sell that stock, you're actually not acknowledging that you screwed up, right? So
yes,
what do? You delay it. It's like the Indian cricket team. There's a player on there who's 38 years old. He's not hit something, I won't name names, it could be Virat Kohli. And Gray used to be a great player, and it's time to let go.
yes,
But you won't, because the minute you let go, you are essentially saying, I screwed up. I should not have kept him on the team for the last 3 years. So you
yes,
know
sir.
what? He's going to stay on and on. This is human nature. So the first thing to remember is behavioral finance describes things that make us human.
Yeah.
For instance, a part of behavioral finance is there's herd behavior. What is herd behavior? You buy what everybody else is buying.
Hmm.
You're saying those sheep.
Yes,
Hey, if you went out to eat last night, and you wanted to pick a restaurant, I don't know, but I'm going to make a guess that we all do this around the world now. Let's say you're in a town that you're not familiar with, and you want to find a restaurant to eat. How do you pick a restaurant? What do you do?
reviews.
Yelp. And Yelp review, not newspaper reviews. You look at Yelp reviews, right? That's a
Yes,
crowd judgment based on, so you go there because that's where everybody else is going. Do you have Netflix?
yes, sir.
Okay. How do you decide? Netflix has the highest proportion of bad shows, good shows of any entertainment platform I've ever been on, right? You sometimes have to click through 7 shows before you find a watchable show.
Hmm.
So how do you pick what show to watch on Netflix?
Possibly the more popular ones that are
The
suggested.
only problem is one is they give you the top 10. So you pick them
Yeah,
and say, how many people are watching it? I'll watch it. Netflix actually doesn't have the star. They used to have the stars. They took it away 10 years ago. But if you go off Netflix to Rotten Tomatoes, have you been on
yes,
Rotten Tomatoes?
yes,
You can look up the reviews of the movies. We live in a world where crowd judgment drives how we behave. Why would investing be any different? Right? So the first thing to remember is behavioral finance doesn't change value by 1 cent. You know what it does? It makes the price be different from value and keep it different. So I think the caution from behavioral finance is the pushback against old time value investing, which is if you buy something that's undervalued, what's supposed to happen? The price will come up to the value and you'll make money. And behavioral finance is not so fast. What if price doesn't come back up to value because there are all these things pushing against it? What if it takes you 15 years before? So that's why investing is not just learning the mechanics of valuation, it's having faith. Strange word to use, faith, because every time you invest, you're showing me I have faith in evaluation and faith that the price will adjust to value. And will it be tested? How many of you are religious? Think about it. Is your faith tested every week?
yes.
A parent gets sick. What's your reaction? how can a just God do this to me?
Yeah.
You call an Uber and it doesn't come. You say, how can a just God do this to me? Right? Everything you do, you say, in a world, I do everything right. I follow every religion, but the essence of faith is, you're going to get tested. You come through still religious the other end. Some people don't. Same thing in investing. You're going to be tested, which means you're going to buy a stock because it's undervalued. What's going to happen the next day? The price is actually going to go in the wrong direction. That's God knocking on your door saying, do you still have faith? It's tough to hold on to. Most portfolio managers have no faith. So you know what they do? How do most portfolio managers decide what to buy and what to sell? They have their own version of Rotten Tomatoes, right? Which is they look to see what's everybody else buying. Oh, they're buying Asian paints. I'm going to buy it too. It might sound surface level, but it's very human. And I don't blame people for doing it, but don't dress it up. And I did a discounted cash flow valuation. That's why I did Asian paints. I know exactly why you did it. There's a lot of hypocrisy in active investing and banking, where you make it look like you did something because you did the analysis, when in fact you decided first based on a behavioral consideration, and then you look for a way to justify what you always wanted to do. Okay? Look in the mirror and be honest with yourself. You can lie to your clients, you can lie to your managing director, you can lie to your colleagues, but don't lie to yourself, because that's the roadway to all kinds of trouble in the future, and especially in personal investing.
Thank you, sir. If I could just extend the question a bit. So as you said, basically not selling of the stock, holding it for long is like basically trying to not admit
First,
your
remember,
mistake.
by the time you got to that problem, the damage has already been done, right? It's a
Okay.
sunk cost, right?
Yeah. So
And you've taken up your corporate finance class. What should you do with sunk costs?
ignore it.
Ignore it, right? But let me
Okay.
ask you a personal question. You stand in line for something, a movie or something, and you think that the line's going to take 15 minutes. 30 minutes later, there are 10 people in front of you in the line. 30 minutes later, there's still 8 people in front. What's your rational side saying? Leave, right?
Yeah.
But then what do you say? But I waited 30 minutes
minutes.
already. Don't lie to me that you never think about it. And if you waited 30 minutes already, what does it do? It basically means you wait in line an extra time. We know in theory what we're supposed. I don't call these irrational. It's human nature. And the only thing you can do is devise things that kind of protect you from yourself. I'll give you an example. If you make this decision of sell by yourself, you will never pull the trigger, because for instance, in a crisis, what are you told? Don't sell into a crisis, because you're going to sell into a panic number. But if you're sitting in front of a computer open online and you're watching the market drop as you look at the screen, I can almost guarantee you that you're going to do all the things you were told not to do. My advice to people in a crisis is take a vacation. With no Wi-Fi and no online connections, we've created a world where there's too much of a feedback loop. 50 years ago, if you bought a stock and it went down, and you were not a broker, an investment, or a banker, when did you find out that it went down?
Next day.
Maybe if you looked at but remember 50 years ago, you'd have had to open to the financial pages, look for your stock. Do you actually do that? Most people wouldn't have. When they'd have found out 3 months later. And by then the stock would have bounced back. They wouldn't even have known about the trauma they should have gone through 6 weeks ago. And that was healthy. We've created a world where all of the behavioral things you talked about have become worse, because we have too much feedback on what's happening and it's too easy for us to act. So take everything you learned in behavioral finance, put it on steroids, and we're in a world where every behavioral thing you worry about is steroids. I automate the things that I know I will not do on my own. When I value companies, I actually do a Monte Carlo simulation where I value the company, I come up with a fair value for the company, but I also have 30% overvalued, 30% undervalued. I buy the stock, and so I put a limit buy at the 30. So basically, it takes that decision out. I buy the stock when it drops 30% below, because I'm not going to feel like buying it if I try to do it, because if it's dropping, you're buying a dropping stock. The other party said, "Why you just wait? It's scary right now." And then I also put in a limit sell on the day that I buy. Sounds like a weird thing, at 30% above the price. You know what a limit sell is, right? Basically, it'll get sold without me acting. The
Yes.
reason I do it is tomorrow the stock goes up 100%. Great choice, right? You made 100%. The stock is now overvalued. Intellectually, you know you should sell it. But what's the other part of you saying? Such a good stock. Let's wait another day. It might go up 150. This is the roadway to ruin. So when you find yourself facing these things and say, I am too weak, and we're all too weak, automate that part of the process so it's out of your hands. Right?
Thank you very much, sir.
Hello, sir. My name is
Yes.
Toshit Dangi. Sir, are you able to hear me?
I can hear you. I can't see your head because you're cut off, but that's fine.
Sir, actually, we live in a new age world, digital world. There is a 24/7 news, social media, and there is a lot of information. While doing a valuation,
No. There's a lot of data.
information out there.
No. Don't use the word information. A lot of data.
Lots
About
of
5% of it is information, right? So first thing is, we live in a world with data. Data can be good, it can be bad, it can be made up. What's our task? To figure out what portion of it is information. Keep going though.
Yes, sir. So while building a narrative of a company, while building a story of a company, we came across many data points, and you can see even news from a other side of the world, like a import tariff, which will be announced by the president of America on
that
BRICS
is
country.
that
It
is
can have a
information. Yeah. So basically the two things you point out to. One is that we drown. Nobody should complain anymore that they don't have enough data, right? 40 years ago, you could have complained because it was a lot of work. Today, we're drowning in data. I call this disclosure diarrhea. There's almost stuff coming at you in every direction, right? And if you just go on missions where you have no end game, you type in, let's say you're valuing a company, type in the word of the name of the company into Google. How many hits are you going to get? I type in Zomato into Google. I'll probably get thousands and thousands of hits, right? And then I start reading each hit. You know where I'm going to end up, right? I'm going to end up in all kinds of dead ends and distractions because I didn't know what I was looking for. So, two pieces of advice. One is never go looking for something unless you have a sense of what you're looking for. I don't go looking for Tesla. I go looking for Tesla electric cars in China because I want to get a sense of how is Tesla doing in China. I want to focus my search on something very specific. So first, don't go looking for data/information unless you know what you're looking for. Second, read less, watch less, think more. Right? Sounds like a weird thing because every week I get emails from people say, what should I read? What should I watch? My response is stop reading so much. I spend, and I have this luxury, at least an hour every day doing absolutely nothing. Some days I spend the entire day doing nothing. I take my dog for a walk and I leave my phone at home. You know why? Because I want to have an empty mind. I want to give my mind a chance to bounce around. You think that's an idle mind? Idle mind is a devil's workshop. It's terrible advice if you think about it. I mean, can you imagine Newton sitting under an apple tree? This was 1650. And let's say Newton actually had an Apple smartphone in his hand. You remember the legend, right? The apple falls from the tree on Newton's head. If he'd had a smartphone in his hand, you know what his reaction would have been, right? First, he'd have looked up on Google search, what happens to people when apples hit their head? And then he'd have thrown the apple to the side and gone back to checking his Facebook and his Instagram and his TikTok videos. And you'd have lost the chance to come up with the laws of gravity. Thank God he didn't have a smartphone in his hand. We are filling our days with, I don't want to say trivial stuff because I don't want to call your Facebook friend post trivial, but we're filling our days with stuff. We're filling our minds with, we're not giving our minds a chance to roam, because that's when you get those, what I call aha moments, where things connect. I'll give you a very simple example. About 8 months ago, I wake up in the morning and I'm in San Diego, which is where I live much of the year. And I see an email from somebody in Iceland. I didn't know the person, but they read my blog and they said, look, I do valuation. I read your book. I read your blogs, but I have a big challenge in my valuation. And I would like to know what to do. And he was valuing an Icelandic spa. Yeah. And the Icelandic spa is legendary. It's been around a long time. And he said, I've done the cash flows and the growth rates based on your book, but here's the problem. I'm not able to bring it to my valuation. There's a volcano that's erupted in Iceland, and the lava is flowing towards the spa. I'm looked everywhere for bringing in lava effects into valuation, but there seems to be nothing out there. Even Google doesn't have an answer. What do I do about this risk of lava coming towards me? I didn't have the answer, but my dog was scratching in the door. He had to go for, so I took him out and left my phone at home. And while I'm walking through, I'm thinking about how do you bring this effect of a catastrophic risk effect into the Icelandic spa is called Blue Lagoon. It's around. You can check it out. It's a great spa. It's been around almost a century. So as I'm thinking about the Icelandic spa and the lava flowing towards it, my mind starts to bounce around, which is what minds tend to do. And I think about a company called 23andMe. Heard of this company? It's a company where you can send saliva samples and they will give you, based on your DNA, your genetic makeup as a person. And a story I was thinking about is a story that came out last year that somebody had hacked into the 23andMe computer system and got the information on the DNA makeup of all 6.5 million customers. Catastrophic event. Something catastrophe. How do you bring that in when you're valuing a company that is a big platform, data privacy? And while I'm thinking about it, I start thinking about fossil fuel companies. So what's that got to do with this? What's a catastrophe that we as a planet are facing? Climate change, right?
Yes.
And if you listen to COP 31, 32, 33, the one in Baku, the one in Dubai, hypocritical nonsense. But if you listen to it, what are they saying? The world is going to end. Climate change is the existential threat. And if you follow that through, what should happen to fossil fuel stock prices? Should collapse, right?
Yes.
And nobody should be buying properties in Manhattan because the seas are rising by 3 feet. There will be no property in Manhattan. Manhattan will not be Manhattan. It's an island, be underwater. And I said, people are still paying $1 billion. Fossil fuel companies are at historic highs. It all brought down, and as I was doing all of this, I said, why am I looking at other people? I live 2 blocks from the Pacific Ocean in California on one of the biggest earthquake faults in the world. And I won't tell you how much I paid for my house, but then I said, what was I thinking? You take your pick, earthquake or tsunami, I'm going to be gone. What the heck was I doing? And they all came down to a common question of how do we as human beings deal with catastrophe? Which brought me to a Mad Max movie. Shows you how your brain jumps around, right? Have you ever watched a Mad Max movie? Yeah, somebody has. It's set in apocalyptic times. The world is essentially collapsed. And I said, watch a Mad Max movie. How often do you see a character there ask, what's my portfolio doing? Never. Why? Because you're surviving. And here's the problem. In a catastrophe, the last thing you think about is what's ExxonMobil worth or what's my house worth. You're too busy surviving. And I said it's human nature to set catastrophe to the side. So you know how we bring in catastrophes into valuation? We don't. We ignore it. We just keep it to the side. And I think this happens around the world because if we thought about it consciously, we would go crazy. If every morning I woke up and checked out the likelihood that an earthquake would strike California or that there'd be a tsunami, I couldn't live. So you just set it to the side. And all of this happened on a 35-minute walk because I didn't have my phone and my brain just bounced around. I came back and wrote a blog post about it. And that's my suggestion. When your brain bounces around, put your thoughts down. If it's a pencil and a journal, put it down. Let it fester. It's a bad word to use. Maybe a different word would be better. Let it fester. Let it just bounce around. And it's amazing how your own thoughts can lead you to insights that go well beyond this day. So never have an unformed mind and Google in front of you, because what's happening then, you're filling your mind in, not just with other people's thoughts, but all kinds of nonsense about a topic. And you've not given, so first let your mind come up with a framework, then go looking. So I'll be quite honest, when I saw the DeepSeek story over the weekend leading into that week, I'm not an AI person. No. If I had just said DeepSeek on Google, I'd have got thousands and thousands of hits on DeepSeek. So I started thinking about, what does DeepSeek do? Why does it challenge the AI story? And what are the things I need to know to reframe the story? And I let my mind kind of come up with a framework. And then I went looking for what exactly is DeepSeek? What are they doing? So let your mind first create its own framework and then go looking for data/information, because you will be in much better shape than just letting it, kind of go over you.
Thank you, sir.
So that was the last question. So as we come to the close of this insightful session, it is my honor to extend a heartfelt vote of thanks on behalf of Team Niveshak at IIM Shillong. First and foremost, our deepest gratitude to Professor Damodaran for sharing his invaluable insights on narrative and numbers. Your ability to blend financial analysis with storytelling has truly transformed the way we perceive valuation and investment strategies. It has been an absolute privilege to learn from you today. We sincerely appreciate your time and expertise, and we look forward to continuing this relationship and collaborating on future events. A special thank you to our esteemed faculty, attendees, and finance enthusiasts from across institutes for joining us and making this session truly engaging. Your enthusiasm and curiosity have added immense value to today's discussion. With that, we conclude today's session. Thank you once again, and we look forward to many more such enriching discussions in the future. Have a great evening.
Thank you. Take care.
Sir, we request you to stay back for a few minutes, if that's okay.
Okay.
Continue.
I can't hear you. I think you're muted again, so.